Life Insurance Secrets Revealed by Verified Advisor Javon Spencer. This chapter, wow, this is the one that really let me understand that there are so many products, there are so many things that they do not want you to know about when it comes to how to leverage life insurance for wealth. You see our logo, Spencer Financial Group, protecting life, health, and wealth. This is the protection of the wealth. These final chapters are the protection of the wealth, how to grow it, how to keep it growing, how to not put your money on the stock market and lose it. Let's dive in. I personally call this the mortgage payoff program. I love the mortgage payoff program because it leverages and talks about a concept of paying debt. This is one thing, how to leverage debt, how to make money off of your debt. Here in this country, debt and American dream go hand in hand. I'm not getting into good debt, bad debt, but we show you how to make money using life insurance on your debt. And it all boils down to a concept called the infinite banking concept. You're going to hear IBC a lot. You're going to hear infinite banking. I like to coin it the mortgage payoff program, talking about what it can do for you. Most people that have a mortgage have heavy debt. That's what you're going to see a lot of in this chapter. It's all the same thing. I really want to share with you the concept, share with you what's available to you, share with you that it's available and how it can help you more than anything. So let's dive in and see if this is something that's even needed for you. But if you don't have a mortgage, this can still help you. So don't get caught up with the marketing terminology of what you see. Just follow how you can leverage it. You might need it for homeowners. That's for people who don't have a mortgage yet. You want to get into a mortgage, you can start leveraging this program up front. Who is this ideal for? These are ideal for people that you don't want a mortgage during your retirement years. Huge. I don't want to pay a mortgage when I'm retired. That's the bulk of the income. People who want to become their private bank. Ding, 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 their private bank, the infinite banking concept, how to be their private bank, independent of government. And people that want to pay off their mortgage without refinancing or increasing their monthly payment. Those are ideally what this concept would do for you. Who am I? My name is Javon Spencer. My wife and I, Bridget, are verified advisors. We reside in beautiful Beaufort, South Carolina with our two sons, Brendan and Darion Spencer. I love this because I'm here to help you and your family eliminate your mortgage debt. Again, like I said, just the marketing, focus on it. If you don't have a mortgage, it's okay. It's still all right. Our tagline, we don't consolidate debt, we don't negotiate debt, we eliminate debt. Real quick before we begin, for my homeowners out there, if your mortgage were paid off, would your retirement be more comfortable? I can just speak from personal experience. If my mortgage was paid off, my right now would be more comfortable. Retirement would take care of itself, but the right now would be comfortable. If your mortgage were paid off, put in the chat, if your mortgage were paid off, would your retirement be more comfortable? Mine 100% would be. So it all starts, why are we here? Sharing the secrets. Knowledge is power. Let's start off with this is not. The mortgage payoff program, infinite banking, it is not a debt consolidation. It is not a refinance. It is not a get rich quick scheme. It is not multi-level marketing. It is not a HELOC. It's not a HELOC at all. Let's just make sure we are clear upon that. Leveraging life insurance for you. Let's discuss this for the American family. So let's just say everyone played the game of life and you're 18 years old, just graduated. As you see, I have an 18-year-old. And let me tell you right now, he is being bombarded with that first line of debt, credit card debt. They are sending more credit card offers to someone who just turned 18 years old. In order to be in the credit bureau, they tell you, got to get some debt. You got to get something in your name. We get a credit card. But now I'm 18, I'm headed out to school. Guess what? I can't pay for my education out of pocket. But they allow me at 18 years old to sign up for what? More debt. Okay, they allow me to sign up for more debt, called student loan debt. Well, now I've been paying on that credit card, got my student loan debt, and I'm now a 700 credit score, and I'm on my way to college. So sometime after my freshman year, I'm gonna need a car. And Toyota just said 0 money down for a nice Corolla. Shout out to everyone that's driving a Corolla. And they let me no money down, and I have debt, and I got a car, and I got college, and let's just say I do great and I graduate, but I can't go to my career with the same car that I just pulled up into a college. So then I go and get into more debt and get a bigger vehicle, maybe start a family now. And now I'm graduated. Now I have my dream job, but I'm renting. And a realtor on my social media said, you should not be paying someone else's mortgage, pay your own. So I buy a house. How many of this sounds like you? I buy a house because there's no way I'm going to be paying someone else's mortgage. And I buy a house. So now I have student loan debt. I have a house. I have a bigger car. I know I picked up a few more credit cards over the years. And now I cannot work every weekend. I can't work 52 weeks out the year without a vacation, but I didn't save enough. I have to take a vacation. I know one of these credit cards will allow me, I can swipe my card. We'll pay it off next year when we get back. And the cycle repeats itself. I just swipe and go, got debt, boom, boom. And before you know it, it's the end. Put in the chat if that's anything close to you or what you're dealing with or anyone that you know, because this is the reality for American families. And I'm not here to say if it's good or bad, it's just what we're faced with, but I'm going to show you how to get ahead of it to make money on it. The reality for the wealthy. So what I'm going to show you, this policy, this concept Walt Disney used, he was turned down by traditional financing. Disney, as you can see what it grown to be. But as he was starting out, he had to borrow money from his bank. He had to borrow money from his life insurance policy to finance his parks. Ray Kroc, to build more stores, Ray Kroc had to use loans against his bank to create McDonald's. It's not something that's brand new. Guess what? What's different is that you now have access to it. You and I now can do it ourselves. Back then, it was not available to everyone. Only the elite, only the super elite, only the who's who was allowed to have access to policies and information like this. Let's start with this gentleman, Mr. Albert Einstein. Power of compound interest. I love this quote. Compound interest is the 8th wonder of the world. He who understands it, earns it. He who doesn't, pays it. Compound interest. So my question to you for the chat, would you rather have $1 million today, or would you rather have a penny doubled every day for 30 days? Let's give you 5 seconds. So $1 million today, or a penny doubled every day for 30 days. Power of compound interest. So a penny doubled every day. Day 1, day 10, $10, day 20, $10,000. Look, by day 27, because a compound interest is doubling every single day, by day 27, you have exceeded that $1 million that you would have took 27 days earlier, all the way up to $10 million. And this is just an example of how the power of compound interest occurred if it was daily. Let's talk about mortgage payoff insurance. How does it work? Again, marketing terminology. Mortgage payoff insurance is just infinite banking. It's just a permanent whole life policy. When doing this, when trying to become your own bank, we needed some requirements of the policy so that it can make sense, because if not, it would fail. But needed to have guaranteed growth. It needed to have you, the consumer, access to cash with no fees or penalties. You needed to contribute flexible. It couldn't be just, this is what it is for life, because our life changes, life happens. And we needed to be able to maximize our resources. We look and say, what in the marketplace now can I grow my money, guaranteed growth, no fees or penalties? What's out there? So we go up, can a savings account give me guaranteed growth? I guess, but is it flexible and maximizing my resources, that 0.25% is max. No. Can a CD give me guaranteed growth? Yeah. But can I access the cash within that CD before the time and not get hit with penalties and fees? No. Can the stock market offer me guaranteed growth? Absolutely not. Can investments offer me guaranteed growth? Absolutely not. What can do all four things and do it well? Ladies and gentlemen, the participating whole life policy. As you noticed, previous chapters, we just talked about standard whole life. This is participating whole life policies. These are very special policies. Maybe 1 out of 20 life insurance agents that you'll be able to speak to have access to this type of policy. Most people are trying to build their infinite banking policy based on IULs. The participating whole life policy is so different because this one, it must be structured with paid up additions. PUA, paid up additions, which gives you access to your cash within 14 days rather than IUL, which can take a couple years. Paid participating whole life policies with paid up additions. With this, you contribute less as you get older, but you get more cash value and death benefit as you get older. Novel concept, you pay less as you get older when your income is now lessening. As we get older, we're out of our working years, we want to contribute less or not contribute at all to a life insurance policy, but we don't want to lose the cash value and death benefit. So that increases as we get older. Again, this is taking advantage of IRS Section 7702. And again, you're making a premium payment, and this tax code is allowing us to put extra money into a life insurance policy and pulling that money out tax-free. So you're being able to make your premium payment, and this time you're putting it into a participating whole life policy. But it's going in two different buckets. It's going into the tax-free death benefit bucket, and it's going into the tax-free compound interest account. Your cash value, the compounding interest. That's where your money is compounding year after year as well. Pop quiz, we're gonna take a break 1 second. Want you to think, wanna engage. What do you think these banks have in common? We have 10 seconds. What do you think these banks have in common? We know they have tellers, the fun stuff, but what do you think they have in common? 5, 4, 3, 2, 1. Boom! They own life insurance as an asset. Now, if the banks are owning life insurance as an asset, and I'm going to the bank to borrow money, how is that? This is the secret. This is why you don't know much about this, because they're the middlemen. They're stopping you. They can advertise. Capital One, Bank of America, they can advertise to you their side of the story, but we're showing you the behind the scenes. Why are they leveraging life insurance in their business, but only telling you about leveraging their CD where they're giving you 1% for their business? We bring this up. Banks ranked by life insurance assets. Let's go down the list. Find your bank. I just love to go by is Regions Bank with $3.4 billion of life insurance assets. Is Regions bigger than Wells Fargo? Absolutely not. Wells Fargo has $19.5 billion of life insurance assets. Is Wells Fargo bigger than Bank of America? Absolutely not. Their value is based off their life insurance assets. Why are they getting life insurance? Why are they putting life insurance on all their executives to leverage their company? Because life insurance is the only financial vehicle that allows you to earn compound interest on the entire balance. Let's say it again. Life insurance is the only financial vehicle that allows you to earn compound interest on the entire balance, even when you're using the money outside the policy. You're earning on everything that's in there, even when you borrowed and take the money outside the policy, so that your money's working twice. So you earn interest on your money and you borrow against your money, all at the same time. all at the same time. Just drop a bomb right there. All at the same time. Now, we're participating on the right side where we borrow money and we pay interest, but the banks are earning interest on the money that they're lending out to us anyway. So they're double dipping, and we're here to show you that you can do the same thing as they are. You can be your own bank. That's the whole concept when you hear that, be your own bank. You can earn interest and borrow money against your money at the same time and do the same thing. And that's what infinite banking, becoming your own bank. Let's talk, how do banks make money? I think that's key. So banks make money. I like to call him Timmy. Timmy comes in, has $1,000 in savings. They guarantee and promise, Timmy, you're going to make 1% by keeping your money in savings with us for the whole year. And in turn, that bank lends money to the guy that wants the mortgage, the guy that wants an auto loan from that bank, the guy that wants a business loan, personal loan, credit card, mortgage again, credit card. That bank can loan out 9 times the amount of money that you put in savings. So if Timmy put in $1,000, now Mr. and Mrs. Bank can now loan out $9,000 against that $1,000. So they promised Timmy $10. They just made $705, which gave them a profit of $695 because they know how to market and promote to you their services. Well, let's talk about how insurance companies make money, because they're not doing it out of the kindness of their heart either. They're making money as well. Let's talk about it. So Timmy goes into an insurance company, or someone like me helps find him the insurance company that has the products that he wants. He signs up for a policy. So Timmy becomes the policy holder. He's the holder. He owns the contract. Well, the insurance company has 2 departments when it comes to loaning out money. They have the upfront, they have the front of the house. They lend money to the big boys, the big companies. They lend it out to the credit card companies, the banks, the mortgage companies. They're the ones that's lending the money out to them. And then they mark it up for us. They mark it up for the public to be able to say, you don't have access to buy. It's like having access to the plug. You don't have access to the wholesaler, I do. So you now have to get the product at the rates that I'm selling it for. That's where so much of the money comes from. The insurance companies saved this country during the Depression. Insurance companies are where the government borrowed money from. That's the front of the house. They loan money out to the third-party lenders. But they also have a back of the house for people that's their policy members. They're like, hey, you don't have to go through them. You can come directly to us. And if you come directly to us, we give you a guarantee, the best rates on the street possible, because you have a policy with us. We're servicing your life insurance. Get your loan from us because we know that you have cash in your policy. We see your cash. You're paying your policy premiums every month going to your cash value account that I can see. Let you make a loan against that. And guess what? I'm not going to touch it. I just pay it back when you can if you want to, but we're not going to touch it. So this is how you make money on your debt. Let's just say we have $20,000 in that compound interest account. There's $20,000 in that account that I put overtime or lump sum dump in, however you prefer. It's $20,000. And I want you guys to visualize that jar is locked. There's nothing coming out of there. Now, I want to make a loan. I want to borrow money from my $20,000. Guys, we don't have to go into that $20,000 account. The insurance company sees that, hey, Timmy has $20,000 with us. He needs to borrow $6,000. I'll give him a loan, and I know that $20,000 is earning compound interest. I'm going to let Timmy still earn compound interest, and I'm going to let him borrow $6,000 because I know he's good for it, because I'm still doing what I promised I'm going to do for him by making his $20,000 work for him regardless. So the insurance company is what's giving out the loan. Ladies and gentlemen, this is how you hear tax-free retirement, tax-free, because the money that's coming back into your account is a loan from the insurance company. Why do I want a loan from the insurance company? Because I don't pay taxes on loans in this country. Why do I love that? Because it's my money that I can decide if I want to pay it back like a line of credit. I have a relationship with this insurance company already. They're on the hook for me and my family for $500,000. That's the collateral. The cash value is your credit limit. In this example, $20,000 is my credit limit. I'm earning 3% compound interest on the money that's in my account. I'm earning $600 a year on the whole $20,000. Even though the fact that the insurance company allowed me to borrow $6,000 does not stop my $20,000 from earning 3% compound interest year over year. My commitment to the insurance company is they're going to charge me 3.85% simple interest. They're going to charge me simple interest. And when you notice the difference between the two, look at the power of compound interest and the power of simple interest. That $6,000, I'm going to owe them $231. Even though I'm using that $6,000 out the policy, my $20,000 is still earning compound interest. They didn't take that, deduct the $6,000 and then start doing the difference. I'm still earning $20,000 compound interest year over year. So when I look at it, I made $600 for keeping my policy completely the same, untouched, uninterrupted is what you hear a lot of the terminology, uninterrupted compound interest. That's where that comes from. It's uninterrupted. Even though I took money out of it, my compound interest is still working the same exact way. And the $6,000 that I borrowed from the insurance company because they see that I have that $20,000, that $6,000, let's just say I pay it back and I paid $231 of interest to the insurance company. But using my own money, I just was able to do whatever I needed to do with that $6,000, pay it back at my leisure, and still made $369 in the process. This is the power of participating whole life policies with paid up additions and infinite banking policies. This is where you hear, let me show you how you use every dollar twice. The $6,000 inside the policy, what is that doing? It's earning interest. I'm earning compound interest. I'm being able to access that for the future. But the money outside the policy, I needed that $6,000. I need a washer, dryer, redo my living room. I needed $6,000 to get a new car for my child. I needed $6,000 to pay off 30% interest. I needed to take that $6,000 to pay off a credit card that was at 30%. And now I can take that money that I was paying to Capital One for the credit card fee and put it towards my policy and earn money in the process. This is better than a loan because it's already your money. It's better than savings because you earn interest on the entire principal, even if you're using your money. We talked about maximizing resources. It's not just about the process. Where can I earn an extra dollar doing less work? This is an example. If I just wanted to buy a car, I want to buy a $20,000 car. Option A, we know that's just been the beginning of time. Let me go borrow $20,000 for a car. Option B, let's grow $20,000 inside of my compound interest account, which is my infinite bank policy, which is my mortgage payoff program, whatever terminology. Let me put that inside my policy first. Then I borrow from the insurance company against that policy. Why is that? Let's show you the numbers. I love numbers. Forget concepts, let's just go pure numbers. 3% compounded after 5 years will make me $3,185 literally doing nothing. Let's just say I took that $20,000 right out at a simple interest loan, it would cost me $2,000. So I was able to do the same transaction, one extra step, I still get the car and I made $1,000 in the same process. These are the secrets right here. So which is the best option? Option A, after 5 years, I just have the car and no principal. I don't have the $20,000 anymore. Or option B, I take the $20,000 from the policy, borrow for myself. After 5 years, guess what? I still have my original $20,000 because the $20,000 that they deposited back in my bank account came from the insurance company. My $20,000 principal is still in my policy earning compound interest. And after I paid myself back from the insurance company's loan, I still made more than $1,000. So it becomes a no-brainer. So let's go through it. Another example, option A. Timmy has $10,000. He wants to buy a car. Option A, buying a car with an auto loan. We see it time and time again. Remember, the banks are great at marketing their products. Get an auto loan. Okay, let's talk about it. $10,000 loan for a car from your bank. You pay $2,300 in interest. Let's talk about over time. Is that the best move? Over time, you no longer have access to the $10,000. As soon as you pay for it, get the title, or as soon as you finish the transaction, that $10,000 is gone. You paid $2,300 in interest, but you own the car. So that's the win. Let's buy a car with cash. You take $10,000 cash for your car from your savings account. Let's look at it, option B, long term. Over time, you don't have the $10,000 anymore. That's gone. So what you could have done to grow that 10,000, maybe had an opportunity or a property that you could have purchased, is gone. You bought the car, but you didn't pay interest and you still own the car. But let's see if you bought a car with your infinite banking policy, your mortgage payoff policy. Let's see if you bought the car with your policy. Now you put $10,000, you took $10,000 out of your policy, and wow, it cost you $1,200 in interest, but you earn $1,900 in compounded growth. Do you still have access to the original $10,000? Yes, because the loan came from the insurance company. Your money is still in your policy. Two different things. Then you made money, you netted a profit on the interest, and you own the car. You still have the $10,000, you made money on the interest, and you own the car. The win-win-win scenario. I'm going to be completely transparent and share with you, this is what I call my mortgage payoff story. Back when we were building and thought that every credit card that hit my mailbox, I thought belonged to me. If they gave me an offer, I jumped on it. And before you knew it, we looked up and it was $263,000 in debt, including student loans, the mortgage, credit card companies, everything, timeshare, it all. And with an average interest rate of 20%. $263,000 will let you sleep at night. That was not the debt. That was not the amount. The real debt was $422,000. By doing this infinite banking, it took our mortgage, our debts from 25.8 years down to 8.5 years, saving close to $70,000 in interest. But the bigger kicker, it freed up so many, the credit cards, it freed up student loans, it freed up so much based off this concept, based off paying yourself, paying your debts, earning interest, and paying everything strategically and guaranteed. What that would do is now frees up the money for retirement. My retirement years, you have access to $826,000, no fees, no penalties, which I will be able to access from my life insurance policy. So what's the benefits? You choose which one of these best benefit you. For me, getting out of debt in less than 9 years, the tax-free favored income by far, peace of mind, huge. Maximizing your cash flow, absolutely. Next steps, we have a form that you'll see on the screen, could be in your email as well. If you want to see your financial analysis, if you take the time, fill out all the information listed, myself or a member of my team will be able to do your financial analysis free of charge and show you what your debt roadmap looks like and what it would take to get out of debt in less than 7 to 9 years without increasing your monthly budget at all. Just doing what you're already doing, putting anything that you're paying extra, putting that into the policy and showing you how to leverage that and not creating another bill. After that, hop on my calendar, hop on our team calendar. Our team would be more than happy to help you. Hopefully you picked up a lot of nuggets in this chapter because it is a lot, but if we need to go over it again, watch the video again, jump on a call with us again. If you have particular questions, you have our emails, our contact, put it in the chat. We'll be more than happy to help you get out of debt. And these again are the secrets that they do not want you to know about. Tap me when you need us. We look forward to helping you. Have a good one.